Hello friends, we'll be discussing another problem which is related to the journal entries transactions that we have discussed earlier. Let's go ahead and figure that out. So as far as we know that we understand how the journal entries are supposed to be passed. So this is just a reiteration thing that we're doing so that you have these journal entries fixed in your mind and that there is no confusion while any problem is supposed to be solved. So let's go ahead and figure out with this illustration now. So the illustration has been mentioned here. Let's read it down for you. E Limited sends out its accounting machines to its customers, which is costing 200 each. So this has been sent to its customer on sale of approval or return basis. All such transactions as per E Limited are passed through the daily day book itself. So that's what they've been doing and they'll be continuing with the same thing. Just before the end of the financial year, 24th of March 2016, they sent 300 such accounting machines. The invoice price which rather they sent those 300 was somewhere around 280 per unit. So 300 units at the cost of 280 per unit. And out of that, only 90 accounting machines were accepted at the rate of 250. It was sent out at 280, but it was accepted at the rate of 250. Only 90 of it. The balance, no reports updated as of now. So you have to pass the journal entries for all these transactions that they've mentioned here in your journal entry book. So let's go ahead and figure that thing out as to what are the journal entries that we'll have to pass here. Let's do that thing. So the first entry that we have passed here is sales account debit to trade receivables account. This entry is only for that many items which has been sold. It was sent out at 280, however we have sold it at 250. That means that difference between 280 and 250, 30 rupees, has to be shown here as a non-sale item. Hence the amount or the entry has been mentioned as sales account debit to trade receivables because it has been sold out at a lesser value as compared to the invoice price. So this is that. The next will be taking the closing stock into consideration now. The next entry that we have passed here is sales account debit to trade receivables account and the amount is 58,800. This is because 300 goods were sent out of which only 20 goods have been sold out. Because 300 goods were sold out or rather sent out and out of which only 90 goods have been sold out or 90 units have been sold out. So balance 210 multiplied by 280, the invoice price at which it was sent is supposed to be the value of the stock that has been sent to the customer. Now the value of the stock over there will differ from the value of the stock that we have ideally because it is at a hyped price. The costing is only 200 rupees. So this will have another entry of closing stock. Let's go ahead and figure that out. So the last entry that we have to pass here is the closing stock entry. That means stock lying with the customer account debit to trading account, which will have a total of 42,000. The reason being the cost price of the good still remains to 200 as compared to the market value, which is 280. So whichever is lower is that supposed to be taken. The closing stock with the market or rather with the sellers or the suppliers is still 210. So if you multiply 210 by 200, you get a total of 42,000. So that is the amount that we have mentioned here as the closing stock amount. So I hope this illustration gave you a lot of clarity about how the journal entries are supposed to be passed, how the closing stock is supposed to be taken into consideration. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.